So yeah, I just want to thanks first all the organizers for putting this preliminary work in progress in the program. This is joint work with my colleagues at the bank, Julio Galvez and Miroslav Pitquico. And the usual disclaimers apply regarding that this is just our opinion, not the banks or the euro system. So let me go straight to what we're trying to address here. So, sorry, a sec. One sec. For some reason, the controls are not working well. There we go. Yeah. So, I mean, in this paper, we're trying to basically understand on a broad level what. How are different cohorts of households affected in a boom and bust cycle, and how these different effects on cohorts of households reflected into what we observe in terms of life cycle profiles for consumption, home ownership, income, etc. We're gonna focus. I mean, the focus of the paper or the quantitative part is going to be based on Spain. If you don't know, Spain has undergone a very strong boom-bust cycle from the early 2000s until 2015, 17. One might argue that that was the full frequency of the cycle, where basically there were strong changes, significant changes in credit conditions, changes in labor income dynamics and labor market structures. But also significant variation in fiscal incentives and property taxes, right? So basically, what we're going to try to do here is try to try to understand what are the role of these three observed changes in the core dynamics. So basically, we have observed some very particular core dynamics in the data. We're going to try to use a model in order to understand them. So basically, as I said, so the approach we're going to take here is first, we're going to use detailed household level for Spain, or panel data on assets, liabilities, consumption, income coming from the Encuesta Financiera de las Familias. This is the similar to the Survey of Consumer Finance in the US. We're gonna take the aggregate changes in credit conditions, income dynamics, and taxes, and we're gonna first carry out a multivariate heterogeneity analysis in order to understand how consumption, insurance, and home ownership changes by asset, income, and age. And we are also gonna, and I think this is important, we're gonna try to actually estimate a generalized nonlinear income process, which is age and history dependent, which we're gonna try to feed then into the structural model. This is important because we think, in particular in Spain, but more in general, this is it's going to be a very non-parametric way to capture the skewness and the non-normalities of the income that we've seen in the US, but also in some other countries, and in particular here in Spain, in terms of the incomes for different households. So, and then we're going to use, as I was saying, a structural life cycle model with housing market equilibrium, with some detailed household decision on consumption, renting, owning, and assets, and we'll basically estimate this model structurally via a simulated method of moments, and we're going to carry out some counterfactual experiments. So let me just briefly resume some of the very preliminary facts. So this is preliminary findings. This is very much work in progress. So again, any comments are going to be welcome. But in terms of the empirical facts, what we find is that basically both consumption and home ownership profiles point to significant age and age heterogeneity in the dynamics between expansion and recession, and which is basically mainly accounted by strong cohort effects. And basically, we also find that there's strong age and history dependence in income dynamics. So for households of different age and income histories, the shocks that we uncover are very different, which translate into age at time variation in marginal propensity to consume. This is comes from the data. In order to understanding these dynamics, we then estimate our model. We show some evidence for identification within the model. We show also that it matches targeted and several non-targeted moments and life cycle profiles. And I mean, this is again preliminary, but what we're finding is that the observed dynamics in the data can be pretty well explained by a combination of the tightening credit conditions, fiscal changes, and worsening the labor income dynamics. Today, for this talk, I'm not going to talk about how the non-linear income dynamics what's the role played in the model, because we are trying to kind of nail down this a bit more. But yes, I'm going to tell you how we estimate this in the data. So briefly, the outline is going to be, I'm going to talk about the data, what we estimate from in particular from micro level data. Briefly go through the model, and then the estimation and the experiments we've carried out so far. And I'm going to conclude with the next steps we're working on, which are still many to come. So let me start with the data and to give you a brief paint of what has been this boom-bust cycle in Spain. You probably most of you already know something about it, but here I'm showing you let's say 4 plots of aggregate variables. On the top left, you have real consumption and disposable income, both non-durable consumption, the red line, and durable consumption, the green line. On the top right, you have aggregate outstanding credit to households, both housing or mortgages and consumption credit. The bottom left, you have housing investment and new housing permits given. And then on the bottom right, you have the aggregate home ownership rate. So I want you to take away 2 or 3 facts from here. The first one is the clear boom and bust cycle in terms of consumption, credit, investment, as you can see in all figures. The second one is that if you look at aggregate outstanding credit to households, the especially mortgage credit has been decreasing since the top of the boom, and basically it hasn't recovered. I would show you here the new credit, mortgage credit. This is well below. This is like 10-20% of what was at the peak of the boom. Basically, households have been deleveraging since 2008. And then basically the other fact is that, as you can see in the bottom left figure, there's the housing investment and how new housing permits has collapsed and hasn't recovered yet since the bottom of the peak. But basically the cycle is still there. And the third one, which I think we find very interesting, is that the home ownership rate, the aggregate or the average in the economy, has been pretty stable, notwithstanding all this cycle that I've showed you. So basically, it has been hovering around 80%. The latest data points to a slight decreasing in this aggregate home ownership rate, but overall, it has been extremely stable, right? So this is in terms of aggregate. Let me show you some micro data on consumption and home ownership. And I want to try to disentangle here some age and cohort effects. On the left column here, I'm showing you the change on top of non-durable consumption between 2008 and 2014. And on the bottom left column, I'm showing you the change in home ownership. So as you can see, there's a strong age component here, especially for ages below 35. The home ownership rate has decreased around 40-50%. I mean, there's a lot of noise in the data for very early ages, but that's kind of the picture. And consumption, the change in consumption has also been very age dependent. So if you look at the right column, where I'm plotting now the different cohorts for consumption, for total consumption at this time and home ownership, you already can see there's also a very strong cohort effects. Households that have entered late or more recently into the labor market and the housing market, they're gonna experience it. They already experienced a very different life cycle profile, right? So this is the broad picture kind of that we've been dealing here in Spain. So finally, let me show you some from this same household level data. Let me show you how the poor and wealthy hand-to-mouth distribution or age distribution look here. So basically, here I'm defining hand-to-mouth households in the same way as it has been done recently in the literature after the Greg Kaplan's and Gianluca's paper in 2014. Basically, households whose liquid asset stock is below half of their monthly income, and they have either requested a loan and haven't gotten the full amount, or haven't gotten all together, or haven't requested a loan because they thought they were not going to get it, right? So apart from the life cycle profile here, what I want to point is that as you've seen in the previous graph, the homeownership rate in Spain is very high relative to other countries. And this is kind of also shown here. Basically, most of the hand-to-mouth households, especially before the boom, so before the BAT, sorry, so in the left panel of this figure, most of the hand-to-mouth households were wealthy households, in the sense that most of them had some kind of, in particular, housing equity, or some other form of illiquid assets, but in mostly housing equity, right? And there's been a change between the boom and the bust too here, in particular for young ages. And in particular now, the proportion of poor hand-to-mouth has increased relative to the previous to the 2008, right? So yeah, let me move now to the second set of analysis that we are carrying out in the data. As I said at the beginning, we're trying to uncover the non-linearities and the present in the income dynamics of households, right? So and why we do this, until very recently in most of these structural heterogeneous aging models, we used to work with linear autoregressive process for income, for exogenous income, where persistence and volatility of those shocks were independent of age and the past history of shocks, right? I mean, if one looks at the data and thinks about it in terms of life cycle and different positions in the income distributions, this seems quite a strong assumption, and one that has been shown to kind of not only not holding the data, but potentially could have strong impacts, significant impacts for the dynamics coming out of this kind of model. So basically what we're trying to do, what we're going to try to do is basically capture this, how the persistence and the skewness of the shocks income shocks faced by household can vary across ages and across income histories. So in particular, let me show you. So if one decomposes labor income, or the logarithm of the labor income, into a household characteristic, or a deterministic component and a stochastic persistence component, until very recently, this stochastic component was modeled as an autoregressive process. What we're going to do here in the paper, we're going to basically estimate a generalized Markov process for conditional quantiles of this stochastic component, and estimate it in a non-parametric way. So what we're going to capture here is that we're going to capture the fact that variance, the skewness are both age and history dependent, as I was mentioning, and also the persistence. So we go and estimate this process from the household level data that I was mentioning before, the panel for households in Spain, and let me show you some results. So this is the contour plots for conditional persistence, and this is for the average age in our sample. So basically, let me explain what these pictures are showing you. Focus first on the left-hand side. This is pre-crisis, pre-2008. On the x-axis, I'm plotting the size of the shock, of the current income shock. So from small shocks on the left to big shocks on the right, also positive income shocks. And then on the y-axis, you have the position of the household in the income distribution. So basically, high numbers here mean this household is high in the income distribution. So the main takeaway of the figure is that, as you can see, before the crisis, big shocks were mean reverting for households in lower income, so in the lower part of the income distribution. But the same for very bad shocks. The bad shocks were basically mean reverting. Here, the blue colors represent a lower persistence. Green and yellow, orange colors represent a higher persistence. So basically, in a sense, the process before 2008, the income dynamics for most households was in some way mean reverting. While what happened when we go and estimate this for the households after the crisis, there's a significant increase in persistence of bad shocks, in particular for households that are low in the income distribution. And these could be households that were very unlucky, but also potentially younger households, less educated households, right? So this is in terms of persistence. What happens in terms of skewness? What we find is also something quite interesting. If you look before the crisis, and this is again consistent with the figure below, this is again on the y-axis. I'm plotting now the size of the shock, and in the y-axis, sorry, in the x-axis, I have the size of the shock, of the income shock, and in the y-axis, I have the conditional skewness. So again, what happens is that, sorry, I think it's not the size of the shock, but the position on the income distribution. So basically, what happens is that before the crisis, again, households with a low in the income distribution were having like a positive skewness in the distribution of shocks. Households in the higher part of the distribution were having a negative skewness, in the sense that, again, this pointing to a mean reverting process in the dynamics for income. While after the crisis, the skewness became negative for all households. So in a sense, the distribution is shifting to the left for all houses, but affecting potentially more those households in the lower part of the distribution. And the third set of estimations that we want to carry in the data before imposing too much structure is about trying to estimate a non-parametric or semi-parametric consumption function. So if you think in terms of a general dynamic life cycle decision problem, you can think of a consumption rule which has the shape the form as the 1.3 here, basically, where consumption depends on the logarithm of liquid assets, income, wealth, and some unobserved taste shifters. So what we do is we go to the data, again, to the same data set on households, a panel of households. We estimate this rule non-parametrically, and we try to compute the average derivatives, which in this setup can be interpreted with some caveats, but can be interpreted as marginal propensity to consume coefficients. So the derivative of this consumption function with respect to income. And this ultimately, our goal is to use part of this as an element in an indirect inference estimation to pin down some of the parameters in the structural model. I'm not going to talk about this last step today. So this is the main results we're getting out of this. Again, we have pre-crisis, or the expansion phase of the cycle on the left, and the bust phase of the cycle on the right. Two main takeaways here. I'm plotting for each age in the x-axis. I'm plotting the derivative of this consumption function for 3%, the 10th percentile, the median, and the 90th percentile of the liquid asset distribution. So two takeaways here, when you compare the expansion with the recession phase, is that there's the difference between when you go into the boom phase, in the bust phase, sorry, the difference between the percentiles in the liquid asset distribution have increased significantly. But also, basically, this derivative has become much flatter and higher than in the expansion phase. And this potentially is going to feed into the way in which households form expectations and expect their income to affect future consumption. So again, this is, as I was saying before, this is something we want to use in the inference for the inference of parameters in our structural model. So let me summarize briefly the key takeaways out of this exercise. The first one is that we have several evidence for significant changes in consumption and housing between boom and bust, and there's strong age and cohort effects. There's also a strong age and history dependence in income dynamics. So these dependent changes between boom and bust, as I have showed you. And there's also a significant change in the correlation or these marginal propensities to consume coefficients for all ages and asset holders in between the two phases of the cycle. So if there are no questions up to this point, I mean, I think it's a good point to stop. If there are any questions about this part, otherwise I will continue. Okay, so
Actually, I have a clarification question.
Yes.
So on home ownership, do you actually have the data on whether people own one house or more than one house? Because I
So
thought
we
that in the
do,
US, it's
yes.
kind of important, right, to understand the boom and the bust.
Yeah, so we do have data on whether there's a household own a secondary house or a secondary home. We also have data on whether they rent out that house. For this project in particular, we haven't exploited that part yet. So well, yeah, I mean, we can discuss later when we go into, but if you have something in mind, a particular reason, I mean, I agree with you, but we haven't yet exploited that part of the data.
I'll see what comes next before telling you
Sorry?
more. I'll see what comes next before telling you more about how it can matter. And my second question was like, so what you find on history dependence for income dynamics, for instance,
yeah,
across boom and bust, to which extent is it consistent with governance findings?
Well, I mean, I mean, it's a different estimation, but it's a different estimation way of looking into the data. But in essence, it's the results are very similar in the sense that we are finding that both the persistence of very bad shocks increases in the recession, but also the skewness becomes much more. Yeah. So in that sense, they are consistent. Again, I mean, the governance results are for the US. This is for Spain. So definitely. I mean, in principle, one would expect. I mean, we didn't have a strong prior other than this comparison, but it's interesting that the results are not just too crazy in a way. So let me go then into briefly describe you the model. So this by now is a relatively standard heterogeneous aging model with the housing market, where households in working age, live through working age and retirement, they make decisions about non-durable consumption, savings in liquid and illiquid assets subject to transaction costs. They can own or rent and upgrade a house, and they leave bequests. So the labor income, as I was describing now, it's going to come from this estimation of the generalized nonlinear process, allowing for a break in the boom and the bust. The housing and rental markets we're going to model in equilibrium, partially segmented. I'm going to come back to this, and this is important. In particular, there's a recent debate on how the segmentation of the housing market, both from the demand and the supply side, affects movement in house prices, consumption, etc. We haven't carved on stone a particular modeling of the market. We are trying to understand exactly how this looks in Spain, but it certainly has an important effect on the simulations and the outcomes of the model. So the credit market is composed by like mortgage market with a horizon T, subject to an origination LTV limit and a payment to income limit, and origination costs. And while the government has a balanced budget where imposes can implement fiscal deductions on mortgage payments, tax on housing transactions, taxes on income, and social security redistribution, right? So this is pretty standard by now in the literature. The dynamic problem for a household is, I mean, the household enters the model at age 25, they retire at age 65, they face a probability of dying each period, but they die with certainty at age 85. So they start each period as a renter and a homeowner, and basically they can decide to remain a renter or decide to buy a house, facing transaction costs for this decision. And homeowners can either remain owners and pay a mortgage balance, they move to a new house, or sell the house. We've also allowed for default in a previous version of the model. We're kind of abstracting right now from default. Why? I mean, they're both computational and empirical reasons. The empirical reason here is that until not long ago, until 4 years ago, it was very difficult for households in Spain to default on the house or on a mortgage loan. There was not such thing as walking away from the house with almost, or let's say relatively low cost as there was in the US. Banks could persecute you in terms of income, etc. So although we did see a spike in default rates during the crisis, the overall defaults on mortgage loans are much lower than in the US. Of course, this is an equilibrium outcome, right? So it's not entirely fair for me to discard this from the model because of that reason, but computationally, that's the route we're taking right now. So in terms of the housing market structure, as I was saying, I mean, there's a recent debate, I mean, which started long ago, but recently emphasized again by the paper by Greg Kaplan, Kurt Mittman, and Gianluca, but also a very recent paper by Dan Greenwald, Adam Guren, about what actually moves house prices and consumption, or what has moved house prices and consumption the last boom and bust cycle, whether it were credit conditions or whether were changes in household expectations, et cetera, et cetera. So this debate is focusing a lot on the importance of having of modeling appropriately the demand segmentation, in the sense that households not being constrained on the amount of housing services that they can demand, but also on the degree of supply segmentation, in the sense of whether houses can be easily converted between the rental houses and owner houses. And this has important effects in these kind of models for the data. So today, what I'm going to do, so I'm going to model house sizes in a finite and discrete number available to rent or buy. Households face features at a fixed adjustment cost when moving. Rental houses are going to be smaller or of lower quality if you want, but there's going to be some overlap in the size of houses that are available for rent and to own. And today I'm going to basically assume that rental and ownership markets are segmented from the supply side. So there's no housing conversion between the two markets. I mean, this is an extreme assumption. Yes.
There's a clarification question.
Yes.
How large is the loan origination parameter and why is it needed?
The cost to originate, you mean?
Yeah, I suppose, yeah.
So it's not a parameter we're estimating right now, and it's not key for what I'm going to show you today. I mean, it's important for some mechanisms in the model, but not for what I'm going to talk about today. So
it can be zero?
It could be zero. Qualitatively, I don't have the results, but qualitatively, the potential is not going to be much change in the main messages that I want to portray today. So what we do is we go and estimate this setup. We are using micro and macro data for Spain. We fix some parameters exogenously. The income process for the households is going to be estimated as explained. So basically this is fed into the model. And the remaining parameters, we have 5 parameters that are going to be estimated via simulated method moments to match some targets. So these are the parameters that are estimated. We have the extra owning utility that households have for owning a house, minimum rental house size, and the housing grid gap. These are parameters that are part of the kind of reduced form way in which model the housing market here, where you have a finite discrete sizes of houses that you can rent or buy. But I mean, this is important for the message of trying to understand the heterogeneity in age and income for the movements in home ownership that we observe in the data. We also estimate the discount rate and the transaction costs from moving a house. So basically, the moments that we target for these parameters are the average home ownership rate, the home ownership rate at age 30 and the home ownership rate at 35. We're targeting 2005, 2008 data. I didn't say that, sorry. So the median LTV for households and the number of transacted houses in each period, basically the number of transactions that we observe in the housing market. So as you can see, two messages. I mean, we can match these moments pretty well. The parameters are pretty tightly estimated, and there's some interesting features in terms of the point estimate. First, I mean, we found quite surprising the fact that the extra utility for owning was 1. So basically, there's no extra, or the data is not pointing to any kind of utility sense in which households might want to own more in Spain, at least from in this kind of within the boundaries of this model. The discount rate is slightly above 1, but remember that here we have also a probability of dying each period. So the discount rate times the probability is below 1. And yeah, so these are the kind of the main points that I want you to take away. So we carry out some exercise, which we think it's important to kind of try to understand whether these parameters are properly identified or not, or inside the model. Or remember that identification in a structural model, the term can be slightly differently used than when you think about identification in a reduced form econometric model. But at the end of the day, it's all about whether two different values of a parameter give you the same observationally equivalent moment within the model, right? So what we do is we basically plot the shape of the simulated method of moment objective function and how does it vary for different values of the parameter around the point estimate that we get from the data. As you can see here, basically, there's quite enough curvature in this objective function that actually kind of reassures us that at least locally, the parameters seem to be well identified in the model, right? So yeah, so so then what we go and do is we plot usually some life cycle profiles. Okay, here there's that, but there should be some the data profiles overlapped on this. But we do, I mean, I'll tell you, we do a pretty good job in matching this. So here we have the income and consumption on the left top panel, home ownership rate profile across age, the loan to value and the debt to total assets profiles, and the hand to mouth or wealthy hand to mouth profiles for different ages. And again, I mean, at least from the one I showed you in the data, the hand to mouth profile, if you remember, this is pretty similar. Sorry, I don't have here the overlap ones from the data. So given this, given the estimated model, the properly at least locally identified, what we do now is try to carry some experiments. So again, I'm not gonna show you as many results as I would have liked to show you today. In particular, regarding the role of the nonlinear income dynamics, which arguably could be one of the most important ones. The issue here is mainly computationally. We're still trying to pin down the proper way in which to discretize this process to feed it into the model in such a way that it still captures the stochastic properties of the income dynamic process in the data. But still, I mean, I think we have some interesting results. So let me show what we're going to do is try to understand in a way the boom and bust, more the bust today. I'm going to talk more about the bust dynamics in Spain. So what has been behind the observed dynamics that I showed you with aggregate and microdata. So we're basically going to sequentially shut down the observed changes in credit supply, in particular the maximum loan to value at origination, the estimated changes in income dynamics. Again, I'm not going to talk much about this today, and the observed changes in incentives to buy, so the mortgage deductions that you get when you from paying your income tax, and property taxes that you pay each period in which you own a house, right? So we're going to try to disentangle in some way age and cohort effects, comparing steady state outcomes with, so comparing different steady states with the transition between them. And we are going to do this both allowing prices to move, so basically having equilibrium prices, but also fixed prices, or a more partial, I'm calling it more partial because, okay, this is a housing equilibrium model, but it's not a general equilibrium in a way. So, but still we're going to look at what happens in the transition when the prices are fixed. So this is quantitatively the experiment we do. So we're going to consider two phases: the loose phase, basically at which the model is calibrated today, which is basically where we had like an average LTV of 95%. Fiscal incentives, so the fiscal deduction from mortgage payment was 15%, and the property tax being 1%. The model period here is 2 years. This is important to understand these figures. So the labor income process is taken from the expansion and the recession phase. And so the tight phase, the credit, so the maximum LTV drops to 70%. Fiscal incentives, so basically the fiscal deductions for mortgage payments disappear. This is what happened in 2012 in Spain. And property taxes increased by 30%. This number, we're still trying to understand exactly how should we pin down this increase, because this is very heterogeneous across regions, and of course it's not time invariant. So one of the points we're going to argue about is that it's going to be important to understand what the counterfaction in which these changes are transitory versus the counterfaction in which these changes are persistent. Of course, we are today in 2020. We don't really know whether, because some of these changes, so in particular the maximum loan to value in Spain, has been pretty persistent. It has dropped a lot compared to the pre-crisis, pre-2008. And has basically stayed there, and it's still there. So basically what I'm trying to say is that we don't really know whether all these changes are transitory or permanent. I mean, they might continue, they might not. Some of them, for example, the property tax has reverted back to 1% in some regions and not in some other regions, right? So, and this depends a lot on when your house was last valued by the local authority, et cetera, right? So there's a lot of heterogeneity there. So let me show you first the comparison between the benchmark steady state, so the loose, what I'm calling today the loose phase, with the steady state in which all of these three changes are implemented. Basically, what has been going on in the data right now. But what I'm going to compare are kind of long-run steady state. So what would be the changes that we would observe is if these changes were permanent, right? And these are the results for. So what I'm showing you here is the change. The percentage change from the benchmark steady state for some moments in the model. On the left column for all ages, the moment for all ages, and on the right column, the moment conditional on households being below 30, right? So as I was saying, the top panel is the experiment where all changes are implemented in the model, so as observed in the data. As what you can see is that in accordance with what I was showing you in the aggregate time series, the aggregate homeownership rate doesn't change much. This is drops by 1%, but the homeownership rate for young households drops significantly. Consumption, this is something that has been pointed out recently in the literature, and this is something we're trying to understand better in the model, because as I showed you in the data, so consumption for young households drops in the data significantly, but much less in the model as it currently stands. And this could come from potentially the way in which households are insuring themselves, and the fact that, as I was telling you before, this experiment does not consider yet the significant changes in income dynamics, and in particular how would that affect income expectation of households. So again, we potentially think that the gap, especially in consumption changes, can be accounted for that. So the other interesting fact is that the price to rent ratio, which I didn't show you in the data for Spain, that there's a reason for that. We're updating right now the house price data, and the rental data in Spain, the rents in Spain, there's not such a good data right now. At the Banque of Spain, we're working together with the ministers here in Spain in order to try to build an homogeneous rent index, which doesn't exist yet in Spain. But in the model, so there's a strong drop in the price to rent ratio, and mostly accounted by an increase in rents, but also a decrease in house prices. Which is something that we have observed in Spain very recently, in particular the spike in the rents due to a purely demand and supply argument. And this is the bottom panel. I'm showing you now what happens when we only implement in the model a drop in the maximum LTV available at origination. but we keep the same fiscal and property taxes that we had in the expansion. And as you can see now, the home ownership rate for young people drops even more, and this is due to a general, or let's say an equilibrium effect, in the sense that when property taxes when property taxes disappear, when property taxes increase and the incentives, the fiscal incentives or the fiscal deductions coming from mortgage payments disappear, there's a stronger change in the house price. So in the house price, and basically older households have a different decision profile in terms of how much housing services consume, and this affects ultimately the way in which young households are able to, how much young households are able to shift between being a renter and an owner. So the difference here comes from that equilibrium effect, and as you can see, still the consumption impact on younger households is quite small relative to the data. So this is something we are actually working on. So yeah, as I was saying, this is the comparison between the benchmark scenario and the scenario in which the observed changes are assumed to last for a pretty long period. And this is the transition between these two states for the dynamics of prices and rents. In blue, you have the dynamics of house prices, and in orange, you have the dynamics of rents. So basically, and rents are in the right axis. So basically, as I was saying, there was a jumping. So basically, due to the equilibrium forces and in particular younger households not being able to buy a house in the benchmark experiment, rents go up and house prices drop, and then there's house prices experience a much higher volatility, or let's say a higher volatility even conditional on or a standard deviation, which comes. I mean, this is also something that one observes in the data, but which comes within the model because of the gaps in between the house sizes that are available for owning. So basically, potentially, when there's given that the fixed adjustment costs and the fact that they're not the houses available for owning are not in a continuous, let's say, line of sizes. This generates a higher movement in terms of prices inside the model, right? So in a sense, what we're trying to understand here is how basically how does the fact that you as a household entered adulthood or enters the model or the labor market or the housing market in the model at a wrong time, I'm calling wrong time here, even in between brackets, but in a sense, how does the boom and bust affect different cohorts of household differently, right? And we want to try to disentangle the age and cohort effects that we observe in the data. So with that in mind, we are more transitional dynamics to the unexpected credit income and fiscal changes, when these are transitory versus permanent, and when in particular when we don't allow prices to adjust, right? And let me just briefly show you some of the results here in terms of the dynamics of different cohorts for home ownership and leverage. So in this case, what I'm showing you is basically what happens when the shocks, when these changes in credit conditions and fiscal deduction and taxes are transitory.
Excuse me.
Yes.
What do you mean by fixed price?
Well, here is the prices are the house prices and rents.
Well, but then if they are fixed, what happes? I mean, the market.
So we are allowing. So we are exactly. So here we are. I'm just showing you what happens. So, and I think so. The previous dynamics. This was for equilibrium price. What happens in the equilibrium prices and rents? This is when basically we don't allow prices, house prices and rents to adjust, but we basically, in order for the market to clear, we allow the supply of both houses for buying and renting to adjust. So this is a non-equilibrium setup. And again, when the shock is temporary. So I'm showing you here the home ownership rate and leverage
So
for three.
It's a partial equilibrium analysis.
Exactly. This is a partial equilibrium. I mean, I don't want to. I didn't call it partial equilibrium because, in a sense,
of again, demand. Then the quantities are determined by demand. Am I correct?
Exactly. You're correct. Yes, that's correct. So here I'm showing you three different cohorts. In blue, the blue line is a cohort for whom the shocks or the crisis, if you want, or the bust, if you want, happens when that cohort was 35 years of age. In orange is the cohort of households for whom the shock hits when they were 27 years of age. And in gray is the cohorts that entered 6 years after, basically. So who entered the market or the model, if you want, when they were 25 years of age or 27 years of age, 6 years after the shock happens. And so given the shock here is temporary, so what I mean here is that there's a mean reversion. So basically loan to values, the maximum loan to value origination, and we are assuming that goes back to the original high level, and the property tax decreases, goes back to the original level, and the fiscal, the deduction for mortgage payments are reintroduced after a certain number of years, which we calibrate to being similar to what the number of years we have experienced right now in Spain since the crisis. And as you can see, so given that the changes are temporary, those households that enter the labor market or the housing market in the model or the labor market when they, after 6 years after the crisis, are very little affected by this change, because again, these were temporary, so they were not the ones that entered the cycle in a bad time. While those households who were 27 when the bust occurred, they basically they delayed both their decision to buy, and also they decreased the size of the first house they own relative to the other cohorts. And you can see also this in terms of the leverage dynamics for these households across age. Here I'm in the x-axis, I'm having age, right? So this I didn't mention this. I hope it's clear. So in a sense, our point here is that in terms of welfare, which I'm not going to talk to, but we're carrying out. I mean, this in terms of welfare and policies, this is clearly very important, because as again, not all households are born equal, if you want, all right? And when you enter the labor market and the housing market, it potentially affects a lot your life cycle dynamics from then on. And this is what happens when the shock actually is permanent. So when we assume that the changes in the maximum loan to value and the changes in fiscal conditions are last for a very long number of periods. And now again, in blue, orange, and gray, I'm plotting the same cohorts as before, as in the previous exercise. But it's, as you can see now, the dynamics for home ownerships and for leverage is kind of different from the one that we had in the temporary change. And this is because precisely the persistent nature of the shock here. So basically, what happens here is that when this younger cohort, the gray one, is entering the labor market and the housing market.
Can you wrap up, because?
Yes, this is my last. This is my last slide.
Fine.
Yes. So as you, what I wanted to show here is that whatever we assume, and something that we haven't yet observed in the data because we're just still living through it, whatever we assume in terms of the persistence of these shocks, but also in terms of the housing market structure, is going to affect a lot the dynamics, the core dynamics, and in particular, it's going to affect a lot welfare, right? Especially during the transition. So yeah, let me wrap up in terms of, I mean, some conclusions and next steps. As I was saying, this is pretty preliminary in many directions. But still, I think we're finding strong nonlinearities and age history dependence in income dynamics in the data. Incorporating, as I said, I mean, the problem here is incorporating this and the band-bust variation into the structural model is not trivial. We are working on that, and both in terms of the particular case for Spain, but more in general, the structure of the housing market is key for understanding the responses to credit and expectational shocks. And again, we are working on that in the model, and in particular, the idea is to carry some meaningful welfare analysis for different cohorts, and both in the transition and the steady state. So yeah, I'm gonna stop here.
Okay, good. So the floor is open.
Maybe Nuno want to start because he had a question.
Yes, Nuno had a question, which is in a different window from.
Yeah, but Nuno can.
Anyway, I can ask it.
Yeah, go ahead.
Hi, Clodo. I was just wondering, why do you focus on the dynamics of home ownership if in the end somehow your estimation says there's no extra utility derived from it, and it's also an illiquid asset? So it seems like there's no real reason for that to be a key variable. Although I think that there's other variables that your model is great for looking at, as like consumption.
I agree. So I agree. So in a way, the estimation is pointing towards that. So we are focusing. So in a way, we're trying to understand what's behind the dynamics that we have observed in the data. But in terms of welfare, I completely agree. I mean, the estimation right now is pointing towards some other potentially more relevant variables that we should look at. Yeah, certainly.
Thanks.
Other points?
Can I ask a question?
Sure.
Yep.
Is there a movement of the interest rate in the model?
No. At the moment, the interest rate is fixed, and there's a spread. There's an exogenous spread on mortgages. So you can think about as Spain being part of in terms of the interest rate, and Spain being part of the European the euro area. But no, interest rates are not moving. Are exogenous. Yeah.
So how dependent are the results on the assumption that essentially rental housing and home ownership are treated as two different goods, right?
Well, so
there is very little, arbitrage between the two kinds, and so you get, opposite movements between prices and rents.
Yeah.
And that sounds to me like a pretty strong result.
I agree. So definitely. So this is what I was mentioning before. I mean, and this is part of a very interesting ongoing debate in this literature on how does the different segmentations from the supply side, which is what you mentioned, basically not being able to convert rental houses into home ownership houses, but also segmentation in terms of demand of households being able to consume.
But is there a legal restriction? Because
so in terms of reconversion of houses, you mean?
Because normally the prices should be something like the PDV of rents, right?
Yeah, exactly. So
if you
as I said
prevent people from moving back and forth between ownership and rents, then this arbitrage condition is broken down. But if it's,
I agree. So
if the gap between prices and the PDV of rents is too big in your model, that might be a bit annoying, and you might want to introduce some mechanism to keep the two in line, the construction of new homes, or some investment cost of turning rentals into ownership or something like that, right?
Yeah, I agree. So as I mentioned at some point, today I was showing results with the extreme case in which the two markets are perfectly cemented, so there's no conversion between the two. So as you say, the prices are going to adjust accordingly in the two markets. So what one could argue, so in Spain, again, this could be an equilibrium outcome, but in Spain, the two markets, the rental and the ownership markets, have been quite segmented in many ways. But it's true also that the supply side, so the construction sector in both markets, has been pretty active until at least in the expansion phase. As I was showing you in the aggregate data, in the bust phase, the housing permit, the new housing permits and housing investment has decreased and collapsed altogether. But I agree. So, and as I was saying, we are not settled yet in terms of how we're going to model this. But and it's for sure something that has a strong impact on prices, rents, and the leverage in the model. Yes, certainly.
Other comments?
If I can ask again, so just one more thing about prices. Is there any way to get a notion of bubble in your model?
You mean if not really right now. Not right now, not really. I mean, we are not modeling any kind of expectational shock, if you want. So at the moment, the model is completely rational. I mean, we are not even given the possibility of considering a rational bubble, if you want. So no, the answer is no.
So just out of Claudio, out of curiosity, I know in the American data, there's a lot of survey data from that time that did show people had some pretty crazy expectations, at least exposed expectations. Do we know what Spanish households thought about housing appreciation would be?
So there is some data even within this same survey, and there's some people that have looked at this, and in particular have found some heterogeneity in the expectation depending on education, depending on whether you already had a house or not. So there is some data on that, and of course it's an issue for us because arguably this kind of boom and bust phase in Spain has been one of the main characteristics was a potentially a kind of a crazy or irrational or whatever you want to call it dynamics of housing market expectations. So so yes, so in that sense the answer to the question yes, and we are not yet accounting that in this model. Yeah.
Thank you.